Greetings, Keith Prather here with an automotive update. Looking forward, the NCM Automotive Demand Index came in a little bit weaker than expected in November. And I've said this many times, but there's some government data lags here that I think could be having a little bit of an impact. But I think even as we look at some of the publicly available data, we do know that there was some deceleration in November. Much of it is going to be government shutdown related. There were not only millions of government workers that were impacted by the shutdown, but there were also hundreds of thousands of U.S. suppliers that were also likewise either furloughed, temporarily laid off, or those that were just, consumers that were afraid. They didn't know when the government shutdown was going to end and whether their job was going to survive it or not. And so you had a real pullback in spending, and a lot of consumers would have been reticent to jump into long-term loans, especially something like on a brand new automobile. So we know that a lot of sales, I may talk about it later, but unit sales dropped from an average of about 16.5 million units per year down to a rate of about 15.6 million through some of the data that we got in November. So seeing the index itself drop from 58.1 to about 57.6 maybe shouldn't surprise us that much. It was down about 0.9% month over month between October and November, and then was about 1.7% lower year over year. So again, getting some weaker signals there overall. As we then dive into inventories, I did notice that inventories are a little more range bound. And I do need to caution here because this inventory data is lagging. There are some estimates and some data points that have been plugged in to try and create where we think inventories were, but we believe that they're still climbing. They're still below the long-term average, but they're starting to recover into levels that we think could be maybe the new normal. Prior to the pandemic, we know that you had to carry inventory on site, and consumers were cash and carry. We don't know that they're exactly there now. There's a lot of people willing to order and wait for a lot of vehicles to come in. I know there's a lot of dealer-to-dealer transfers taking place, but I don't know that we've hit that market yet where dealers are losing sales because someone, in another part of town has a vehicle instantly available, and consumers don't want to wait. We may be seeing that take place though as we kind of get into 2026. And so I'm wondering if these inventory to sales ratios will continue to go up and maybe start to approach, pre-COVID levels. Sales, again, as we said, were a little bit lower. 6.4% higher year over year is kind of interesting, but coming in at 15.6 million in units annually. So recently we saw that move as high as 17 million units a year. So, it feels like we improved just a little bit month over month, but again, we still stay lower than where we probably would like to see those. And so we'll see what happens in 2026. I think there are some things that can help spur those sales and spur that growth. So again, I need to go back to the Federal Reserve when it comes to automotive specifically because we know that the Fed trimmed 25 basis points in December. So that brings all the cuts in 2025 to about 75 basis points. They're signaling that we're going to get one more in 2026. We are going to get a Fed changeover that happens in May. We're probably going to get a new Fed chairman. We're also going to get three new board of governors that are voting members that come in May. Most of them, I will tell you, are hawkish, meaning they like to keep interest rates higher. And that may sway the board a little bit, and it may be much more difficult for a brand new chairman to try and meet the thoughts of both the Treasury Secretary and obviously the president in trying to get interest rates lower. but we think that at least the Fed itself, which is very conservative, is signaling at least one more cut next year, and then maybe one more after that before it hits its terminal rate of about 3%. But what I wanted to point out to you was a couple of things very important for automotive. Number one, the Fed's forecast for 2026 was economic growth of about 1.8%. For 2026, they adjusted it then to about 2.3%. So that five basis points in change is significant on a $24 trillion economy. You're talking about hundreds of billions of dollars in differences between GDP growth and the prior forecast and where they're forecasting now. And then even for 2027, they picked up that growth rate a little bit. I can tell you a lot of that's coming because they believe that the tax bill will kick more cash into consumers' pockets. I think the business community will start investing more faster. And so if you do automotive sales and you're in fleet sales, watch for that to kick off. You're going to see some improvements there overall. I think also we're going to see, the consumer market start to improve a little bit, and maybe some consumers that have been on the fence for 2 or 3 years kind of come back into the fold, and maybe we make up for what has been a little bit of pulled back or pent up demand that may be created and sitting on the sidelines. I was concerned about unemployment kind of heading into the new year. We did see it inch up in the latest data. There was a lot of noise in the October employment data, which we just got. You had government layoffs that started in the beginning of the year, that finally those government workers, after a 7 to 8 month hiatus and buyout, were now finally hitting the unemployment rolls. So that created part of the surge. You had the government shutdown, which created some of the surge. And so I don't know that we got a fair signal or fair indicator in October. I think we're going to have to watch it next year. Now, the Federal Reserve believes that the unemployment rate actually comes down a little bit, that we go from 4.5 at the end of 2025, probably to 4.4 next year, and then drops to 4.2 over the next 2 years after that. I will say it's interesting, but there are demographic forecasts out there to show more than 22 million baby boomers hitting retirement eligibility over the next 5 years. And we're only going to add about 2.3 million workers into the US at the same time. You've seen some forecasts out there by some economists that are calling for a depression in 2029. The reason for that forecast is this inversion in the labor market. So because of AI and AI adoption, we're seeing a little bit of an acceleration in layoffs right now, but that's going to get overtaken by this longer term demographic trend where we lose far too many workers over the next 5 to 6 years. Companies are going to have to do things to try and compensate for that loss in productivity. And that's where that projection of a real economic drop coming at the end of the decade, that's where that's coming in. Again, some economic forecasting firms out there calling for a depression starting in 2029, carrying over into 30, 31, and 32. So I don't have that kind of feeling. I don't believe that that's there. I think that companies are resilient, companies are innovative. I think automation, robotics, a lot of things will help compensate. Not to say we won't go through some challenges, but I'm just saying that, watch your sales, watch your showroom floors. There's going to be some shifts and some changes in the types of consumers hitting our showroom floors over the next several years. And a lot of it will be based on what happens with these demographic changes. So you've got some former workers that are hitting retirement age that are going to decide to go in and make maybe a purchase that will last them 5 to 10 years. And that will dictate a very different type of vehicle than maybe what they've been driving over the last 20 years of their life as they're commuting to work. The flip side of that is you're going to have a lot of younger workers that are suddenly going to be in high demand. Their wages are going to surge. You're going to get a lot of bonuses for staying on to jobs. And I think you're going to see that side of the market also surge. A lot of fleet sales. If our GDP rates hit this and it's driven heavily by a lot of commercial construction spending, you're going to see a lot of fleet sales increase in 2026. Now, again, I want to show you this chart because we believe it's probably going to take us into Q2 before we start to see the benefits or see the reactions to some of these market stimulus activities. So we do know that there's a new surge in construction spending likely to kick in kind of mid part of next year. I am getting construction forecasts from a lot of general contractors out there, and many of them are backlogged through the end of 2026 and early into 2027. But many of them can't get projects started until mid 2026 just because of labor availability, trying to get permitting, and a lot of the regulatory processes overcome. And so I think you will see a bit of a surge in growth mid-year based on the commercial side of construction. The non-residential side of construction is supposed to pick up with it. You have the tax benefits that are going to be realized in Q1 this year, which should give the average household about a $2,500 tax rebate. That equates to about $100 to $200 a month. We're also watching the mortgage markets very closely, and we're watching the 10-year. And if the 10-year comes below 4%, you're going to see a lot of mortgage refinancing, which could free up another $200 to $250 a month. So it's by no accident that between the tax bill and bringing U.S. Treasury rates down, that some households could see as much as $400 to $500 a month in extra disposable income. And if you think about where that sits relative to the average new car loan, monthly loan payment, they're very closely related. So I have a feeling it's going to be a very interesting year for automotive. I don't want to predict that it's going to be a boom year or a phenomenal year, but I do think there are going to be a lot of pockets of growth. They're going to come out of the woodwork unexpectedly. You're watching some economic data, and then boom, you're going to get hit with a lot of foot traffic. I do think some of the upper end vehicles are going to start selling a little better than they have over the last half a year as well. That has to do with consumer sentiment and kind of where those are. Now, our production forecast for automotive is still fairly flat, and there's so much volatility in this particular metric. We are seeing some scenarios. So again, these curves are created by 1,000 simulations on the data. And in a worst case scenario, the automotive production number is actually showing a recession risk, and this would be a secular recession risk, just an automotive sector, if a number of economic metrics were to hit worst case scenarios, right? We don't think that's going to happen. The prediction is this orange line, solid orange line, which shows a bit of a roller coaster year. We don't like the fact that we're getting this signal on the back end of 26 and 27. But there's a lot of volatility in that part of the curve. And we think as we move into 2026 that the back end of this curve probably improves. And what we're hoping happens is that it goes up and it exceeds maybe production levels that we have been at over the last several years. Again, the upside potential here is dramatic. And so if we get the upside positive growth stories on some of these scenarios, it would be painting a much more aggressive growth curve. So again, a lot of volatility here, but the overall forecast looks like it could be okay. So that's what I had for you this month. We're going to have a lot more information for you in January. There's so many different metrics that we're watching right now that have to do with what we see in auto sales. I hope you'll stick with us. I hope you keep coming back to this in the macro report. We'll have, again, a lot more details. We get a lot more government data and get a lot more clarity on what's going to happen with tax rebates and tax refunds, and then what happens in the commercial spending and commercial investment side of the economy. We're watching, again, as I said, the 10-year Treasury and the 5-year Treasury because those set interest rates on automotive purchases more so than anything else, and they affect mortgage rates more than anything else. So right now, with the 10-year Treasury sitting at 4.11%, if it goes below 4%, that's a psychological threshold whereby a lot of households right now sitting with mortgage rates at 7.5%. When they suddenly see a mortgage opportunity out there at about 6%, they're going to go in and refinance, and refinancing is going to free up $200 to $300 a month in extra liquidity that they can use for other things, especially automotive purchases. If it goes to 3.5%, now you're getting mortgage rates down below 5%, and a much larger percentage of the overall mortgage holder market will come back in, go through the refi process, and you'll see more households even free up than before. So again, a lot of things to watch. I'll have a much better update for you in January on where a lot of these conditions are going. And until then, I just hope you all have a very Merry Christmas. I hope you have a Happy New Year. Stay safe. I hope everyone stays healthy, and we'll see you in 2026. All right. I appreciate everyone. Take care. Bye bye.